This podcast is for informational purposes only and does not constitute legal, tax, investment, financial, or other advice. It is not intended to cause or induce breach of an existing agency agreement.
Hello? 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 This is the Vancouver
Commercial
Real Estate Podcast.
And welcome back to the Vancouver Commercial Real Estate Podcast. I'm Cory Wright.
And I'm Adam Scalina. And Cory, I got to say, you're dressed like it's Friday. It's actually only Thursday.
Yeah, well, you know, this,
Is that a Harry Rosen?
No,
I can't tell. It's a nice looking sweater.
Well, you know, I missed a week of the Peloton there, right? So in my body at my age, if I drive by McDonald's, I just gain weight. I don't have to pull it anymore. So that 1 week of Peloton's really limited my outfits, including the collars on my dress shirts that don't do up right now. So I'm in the sweater probably for the next 10 days till I can get this 1 week off of the Peloton weight off of me.
So you don't have to tell me the whole story. I heard the Cole's notes, but you fell off a bike and the bike was a Peloton.
So the left pedal was wobbling.
Right.
Which most people's brain is like, hey, I should stop, get off, find out what's going on. My brain, hey, let's get off the seat, crank the tension, see how fast we can go.
Right.
So when I did that, the pedal just snapped right in half. And I really wish I could have seen what happened, because it's like almost like I felt like I was rolling in an avalanche.
It could have been viral.
It happened so fast. And next thing you know, I have one leg on the Peloton, one leg off the Peloton. I'm on the floor at some point. It was a bad situation.
Are you the first guy to fall off?
Well, the girl at Peloton,
stationary bike.
The girl at Peloton on the customer service line, and the guy that showed up to fix it made me feel like I was the first guy that's ever happened.
Such a good story. I'm glad we got to revisit that. Every week we should revisit that.
This story's got about a good 3 episodes run on it here. So,
well, let's not bury the lead. We've got a fantastic episode today. We've got John Switzer. He is from Impact Commercial, and just generally a wealth of information, John.
Totally. And I think right now, too, we had to get them on the show right away. Interest rates have obviously taken a very dramatic and sharp climb up, I think a lot faster than a lot of people anticipated. So we had to, unfortunately, bump a guest, get them on right away, because we had to get some inside knowledge of what's happened, where are they going, because a lot of people have a lot of questions. A lot of listeners have reached out. So we wanted to get John on the show. Very good insight, breaks down what's happened and where they're going to give you a lot there. And also at the same point in time, it says, hey, it's all going to be okay. Here's what you got to look for when you buy. Don't worry about a thing.
Yeah, it's so fascinating because we've been talking about a lot about interest rates on the residential show. And it's clearly, there's a lot of parallels, but at the same time, it's very different, right? In commercial
100%.
Versus residential.
And the one thing too that we benefit for is, although you have townhouses, condos, and houses, they're all used for the same thing, more or less, right? For living. Versus commercial, we have industrial, office, development land, self-storage, retail, so many different other asset classes. So when some asset classes don't do as well, other ones pick up the slack and vice versa. So you've got a lot of options always going on. So there's not as much scarcity, because you can always pivot the assets you're looking to buy and stuff like that. So we get we can weather it a little bit better. Although maybe you can in residential, but nevertheless, they are going to be affected by interest rates for sure.
Yeah, it's a fascinating conversation with John, who's going to be affected and where he thinks there's going to be potential softness in the market and what he thinks is going to just kind of persevere. So it's a great conversation. Looking forward to that. Cory, one quick question I have for you before, does this create any opportunity for people?
Yeah, I think what you're going to find too, and John talks a little bit on the show there's probably some people that may have bought some properties that maybe they have development land, especially where you might have some bridge debt on the property. Bridge debt is, I'm buying it, today for this, I'm going to improve the property or renovate the property or build on the property, but I can't get conventional financing on it. So I got to take out higher interest. And sometimes those higher interest could be a variable where you might be, 7-8% a year ago. And now you could be like 9 or 10%. So there could be opportunities there. And you also might see it too, a little bit of sticker shock out there when buyers go to buy property. They think they're putting 25 or 30% down, but because of the higher interest rates, their loan to value is far less, and they get told, hey, you can buy it, but you need 40 or 45% down. That might have a little bit of effect in the short term, where a lot of buyers have to pull out of deals unexpectedly. And then, sellers are on the market a little bit longer. Inventory beefs up a little bit. So, you got to, in commercial, you got to buy location. Location, know what you're doing that way. As long as you keep to that strategy, you might find a good opportunity here and there.
That's fantastic. All right. Well, without further ado, let's cut to our conversation with John Switzer.
Enjoy, guys. This week's episode is brought to you by our great friends at Impact Commercial Group.
Really enjoy working with Impact Commercial. And we should say Al and his team can basically do anything when it comes to lending.
Anything when it comes to under the commercial umbrella. You're building a building and development, we got you covered. You're buying land, we'll make that happen for you. You're investing in a property or multifamily building, check. Owner-occupiers looking to acquire their own space, double check. Anything commercial financing you need, Impact Commercial is your go-to.
ImpactCommercial.ca. And we should say over 50 years of combined experience. So trust these guys. They're the right fit.
Best in the business, in my opinion.
Okay, so we're here with John Switzer. He is partner at Impact Commercial. How you doing, John?
Doing great today, guys. Thanks for having me on again.
Thanks for taking the time, John. For some of our listeners that don't know you, can you tell us a little bit about yourself?
Sure. I've been with Impact Commercial for just about 5 years now. Got into this industry a little later maybe than most. I was in the investment world before this, but best decision I've ever made, and loving the industry and working with the guys here at Impact and all of our awesome clients.
John, I take pride in saying this. You are a past guest and a Matt fan favorite. Thank you so much for joining us.
That's awesome,
as always.
Guys.
We'll just jump right into this thing. The big pink elephant in the room, whether you're in residential or commercial, is interest rates. And we wanted to have you on today to talk about that. There's been a lot of it swirling in the news about how fast interest rates have gone up. There's been a lot of stuff, dictated by inflation. So can we sort of start off maybe just giving us a recap of where we were, say, 6 months ago? Where are we now? And how does that compare to, say, we were like 3 years ago or 4 years ago pre-COVID?
Sure. So, yeah, I think going back pre-COVID, we were in kind of this not super high growth, actually a little bit depressed growth of kind of from my memory, the low 2% range was our real GDP numbers heading into COVID, with some optimism, but that was crushed pretty quickly in the spring of 2020. And then after a bunch of fear subsided at the beginning of the pandemic, we were suddenly faced with a ton of money on the sidelines and a very bullish buyer base in real estate. That all happened really quickly, but you combine that with record low interest rates, and we ended up with the extremely hot market that we've been in for the past 2 years. So basically the record low overnight rate at the Bank of Canada was 0.25%, 0.25 basis or 25 basis points. And basically that set the stage for some of the lowest mortgage rates in history. So we had, going back just over a year ago, we were funding larger commercial mortgages in kind of the mid 2% range. And fast forward to today, we're looking at rates almost approaching 5% for that same 5-year term. So
wow.
I remember at the beginning of last year, we did one at 2.65 for a very strong borrower, and that same borrower today might be looking at 4.75.
Well, and when you say strong borrower, you're referring to like me and Adam as borrowers, like that type of strong,
of course.
or
Yeah.
this guy's.
I was the 5.
Yeah,
I
can't
was
get much
5
stronger.
then.
You were 5. John told me earlier 6.8 when I called him. So
for context, I'll just say these guys were about as strong as I've worked with.
Oh, okay, so it was me and Adam then. Okay.
I'll let the listeners deduct the rest. But
and John, one thing just for our listeners, you talk about the posted rate of 0.25% with the Bank of Canada. Can you maybe shed a little bit of light? What does that reflect? Because obviously BMO and CIBC aren't lending money out at 0.25%. Can we put into context for listeners what that represents?
Yeah, it's basically the Canadian government influences demand through setting this rate. So basically the overnight lending rate is the rate that banks will lend to each other at the end of the day to settle their accounts and to meet their capital ratios. That's a whole other show. But basically, if one bank comes to the end of the day with more capital than they need to meet their regulated ratios, they can lend it to other banks that are short, or banks can borrow directly from the Bank of Canada lending window. And it's called a target rate. It doesn't have to be exactly 0.25%, but that's where they target that rate. So that's basically the cheapest money out there, because it's large institutions that have the highest credit worthiness. So all other rates are set off of that. So it's just kind of a cascade effect. So everything from bankers' acceptance to government bonds to the final mortgage rates that we see build off of that overnight rate.
Gotcha.
So John, I'm just thinking from the residential perspective, just in the last week or so, a lot of people have moved to the sidelines in our market. And, we were kind of already a spotty market in residential, in the sense that we were starting to notice some sub-markets were not as hot as it has been. And now, just this past weekend, we noticed that a lot of people after the weekend that were expecting multiples didn't get multiples. And the market's definitely shifting right now in residential. What's your take on the commercial market?
It's a broad question. We have so many different facets of commercial compared to residential. You've got, industrial on one hand is so much in need by businesses, and there's such a lack of long-term supply. It's really hard to see the end of this supply-demand imbalance that I think it's going to have to be one of the least affected markets. But I think everything will be affected on a sliding scale. So multifamily is traditionally the strongest, if not or the second, if not the strongest asset class in commercial. So, it'll probably be fairly resilient as well. But I mean, everything is going to get affected by this. It messes up development pro formas that are looking out 2 years. If you're looking at rates that are 1.5% to almost 2% higher, not even a year from now, which is what is kind of the consensus right now among economists, that has to weigh on a market. So it's really hard to say how much, but I think we are sort of, we talk about it a lot here at Impact, and we all are sort of the belief that in the next probably 2 to 3 years, we're going to see some potentially significant softening. It's just, I don't know how it can't happen. But as always, the strong will survive and thrive. And I think there'll be a lot of well-capitalized groups on the sidelines that are looking for that kind of re-entry window when that softness comes. And that'll probably be the start of, the next bull run, and interest rates might have come down by then. So yeah, it's really hard to predict exactly how much things will be affected, but I think everything's going to take a bit of a hit if we see rates up 4%, call it, from where they were a year ago. And that, honestly, that could happen.
So I'm just thinking, and again, since I'm the layman in the room here with you and Cory, in residential, it seems like interest rates is a real kind of punch in the face to the market. It sounds to me like commercial is just a bit more resilient, and probably just due to supply restraints. Is that fair?
Yeah, I think that's particularly in industrial, where we have some of the lowest vacancy in North America, in the lower mainland in industrial. So it's hard to see, like, what you would see in a more kind of balanced market is rising interest rates would cause cap rates to rise, to compensate buyers and basically be competitive with other investment options out there like bonds. But industrial is such an unusual market here that it seems to be fairly bulletproof. It could soften a little bit. You could have some marginal developers sitting on land that they're barely affording. Those are the guys that might be forced to turn over properties. But I don't think there's enough of that out there to take a big bite out of industrial. We could see a little bit of upward pressure on cap rates. Some of the other, like multifamily, is a little bit more of kind of what am I trying to say?
Stabilized?
It's just, well, it's stabilized, but it's discretionary. It's more discretionary. Like you've got big groups out there looking for multifamily that they don't have to buy it. If they don't see the numbers working, they can sit on the sidelines and wait for an opportunity. Whereas large industrial owner users are going to be out there fighting for every square foot, right? So that's the difference there. And then, I mean, office, there's already, we have a really healthy office market here despite everything that's happened, but there's not a lot of office for sale, frankly. It's much more of a leasing environment still in office. There's more and more strata being built, but you just don't see it as much. So, and then I think retail could be an interesting one actually, because a lot of the economists I follow are saying they're like, I was listening to an RBC commentary the other day, and they were saying there's going to be a major shift here from retail to more travel and service-oriented spending, and that actually there's a ton of money on the sidelines. They're estimating there's $300 billion in savings among Canadian households because of all the stimulus that's happened and not as much spending as usual. It's kind of been this double-sided effect of just having a huge amount of money on the sidelines. So I think that could bolster retail, but it's also going to flow into the tourism and service sectors. So it's not all doom and gloom, and it's going to be interesting to see what offset takes place there. Where does that money flow to?
Well, I think I can clear the air with one thing. I mean, I can tell you where none of that $300 billion is. It's not in my account. It's probably not in Adam's account. So we'll just clear the air there right now.
Speak for yourself, Cory.
Yeah, that's true. That's true. Yeah.
I don't know where it is.
Well, as I should say that prior to this going on, we are talking about Adam had purchased a house in Kelowna. So I know he's probably got at least $8 million in the bank with that house since he probably bought it last year. So he's doing okay.
There you go.
John, obviously inflation has played a major impact in the quick rise of interest rates here. Can you maybe talk a little bit how they correlate a little bit? And then if we're watching inflation, is there, as we see that start to hopefully, fingers crossed, in the future, bend and start coming backwards on it, will that sort of be a leeway to watch rates kind of plateau, or what's the correlation there?
Well, yeah, we're actually recommending that clients look at 3-year fixed rates right now, which has not been the story. It's been 5 years all the way because we've had these record low rates. Now we're getting up to a point where we think rates may actually start to come back down in the next 2 to 3 years, and there might be a good refinancing opportunity in that next 2 to 3 year window. The Bank of Canada is seeing the target 2% inflation not revisit until 2024. So it's a ways out, and it takes a really long time to fight back inflation that we've been seeing. And on that note, last night I sent Cory a quick email saying, hey, good timing. They just posted a 31-year high, 6.7% year-over-year inflation print for March. So that's a big problem. And one of Doug Porter's comments was that we have a major inflation problem here, and it's going to take an aggressive approach from the Bank of Canada, and it's going to take time. And I've had clients say, well, this is all taking place because of the war in the Ukraine and what it's doing to commodities. But I don't think that's the case. This was well on its way before the war broke out.
Yeah.
And that's just exacerbated things. And I think it can take on a bit of a life of its own where people believe prices are going higher, so they will continue to drive prices higher. And because they're expecting higher prices in the future. So that's kind of what we're hearing. And the Bank of Canada believes we'll see 2.5% in the second half of next year. And like I said, followed by hitting their 2% target again in 2024. So that's when we think they'll start lowering rates again, is within that time frame.
And John, do you have anything positive to say at all today?
Well, I thought the $300 billion in savings was pretty positive.
That might be in Adam's account. It's definitely not in mine.
Yeah, but that could be an offset though. But yeah, I'm looking around here at my notes. Not a ton, Cory.
Well, I think to be honest with you, obviously we've seen this enormous bull run of a market as of late over the past couple of years, and I think if we COVID hit, there was so much uncertainty. Probably the last thing we all thought of when we're sitting in our basements with everything shut down, or we're watching the news to find out what's going on, that people think, hey, real estate's going to take off. And fast forward 2 years, that's happened. Where do you anticipate things kind of, progressing here? Obviously, interest rates we're tying is there's the higher interest rates obviously have to have some sort of softening effect. Are you guys seeing that on the lending side? Are you seeing less deals come across the plate because interest rates are rising? Or are you guys still seeing a steady flow of deals or even an increase of deals where maybe in the short term that hasn't sort of affected the actual transaction side of the business yet?
Yeah, you know what? It's important to maybe take a step back. It is definitely not all doom and gloom. And I think that savings number is really important for continuing to drive the market. And when we say it's going to affect the market, I don't think you're going to have any negative pricing in real estate. I don't think you're going to see prices fall dramatically, if at all. I just think we've been going up at pretty crazy intervals, especially in industrial and multifamily.
Yeah.
I just think we're going to see more moderate growth. We're going to see more kind of balanced, maybe, keeping up with inflation, which is still very, very strong. So I'm actually quite bullish. It's just, you see these high interest rates and it scares people, but real estate historically has stayed ahead of inflation. So as long as you can afford to hang on to your real estate, you can afford to keep debt servicing your mortgage payments, then you should actually continue to do quite well. So it's a more of a positive outlook, actually.
As we enter this climate of higher interest rates, is there an investment strategy that you guys see more often than not? Are they buying from an equity standpoint? Are people now looking for higher cap rates in secondary, tertiary markets where they can buy cash flow, which might be more resilient in the event things start to, slow down at all? Are you seeing more deals come around in markets like that now, maybe than what you saw last year?
We are seeing, I would say we're seeing a rush of newer entrants into the commercial market, into those tertiary markets.
Yeah.
And the markets in, central and northern BC have been red hot. And I think they could stay quite stable because the cap rates are there to support these higher mortgage payments. But no matter what, you're going to see lower loan to values across all markets. It's a direct relationship between higher interest rates and lower loan to value. So yeah, the answer is kind of twofold. Yes, we're seeing a very active market in those those much higher cap rate jurisdictions, but we also have, I would say, kind of the old money, or the institutional money is always going to be shopping in the major centers, and that, I don't think that's ever going to change. You're not going to see them going up to Fort St. John or Prince George en masse. They're going to go where the big population growth is, and they're not necessarily worried about, tremendously strong cash flow. They're looking at where is this market headed in the next 10, 20 years. And I think that's where all real estate investors should be looking. And if you're looking out beyond that sort of 5 to 10 year time frame, then I don't think there's actually that much negativity out there. I think it's still a good time if you can feel comfortable about your debt servicing.
Now, John, you just touched base there a little bit on the loan to value aspect of it. Can you maybe elaborate a little bit more about, obviously, these higher interest rates make it, harder and harder from a purchaser standpoint, keeping a attractive loan to value. Can you maybe touch base a little bit maybe on what a loan to value is? And then obviously if we fast forward a little bit here and we hit higher and higher interest rates, how that will affect the loan to value, equating to a larger down payment?
Yeah. So, loan to value on a purchase is simply the loan amount divided into the purchase price. So very straightforward, little trickier on, or a few more moving parts on a refinancing, but that's how simple it is on a purchase. And I would say when we were looking at rates, in the high 2s, low 3s, just over a year ago, we were looking at, I want to say, an average of honestly 50 to 55% loan to value across the Lower Mainland. It wasn't that great. So it took pretty deep pockets to get into a property like pretty much any property in the Lower Mainland on a conventional mortgage basis. Now we're going to be looking at well under 50% with these interest rates as long as prices remain stable. So if people keep paying the same price and we've got interest rates 1 or 2% higher, the only thing that can move is the mortgage amount, and that's just going to directly affect your down payment. So yeah, it is going to get harder to get into real estate, but we deal with a lot of owner occupiers that can debt service their loans multiple times over. So that's what I think is gonna support the more commercial markets outside of multifamily, is just really strong income statements and the ability to debt service even if things get quite a bit tougher from here.
So the positivity just continues to roll on.
Well, we are in a very strong business environment. Like the biggest impediment to businesses right now is supply chain issues, which is generally a pretty good thing if that's your biggest problem. We have probably too much demand, which is what's driving inflation right now. So things on the business front are actually very positive. There's lots of cash. Really, the biggest thing is just the risk of running into debt servicing issues. But as long as you're conservative in your pro formas, your projections, that can be managed, I think, quite well.
And are rents going up at the moment? I know we're talking about a lot of different asset classes here, but generally speaking, are rents going up in the Lower Mainland?
Rents have been going up rapidly, actually. So we're now seeing, projections from our industrial broker referral network. They're telling us to use $20 to $22 a square foot for net rents on industrial, which was unheard of even 2 years ago. We were looking at $12 to $14. So we've had this huge move in land and property values, but it's been, thankfully offset quite largely by lease rates going up. So, and then multifamily, same thing. We've seen rent rates go up very quickly. Part of the problem there is there's such tight restrictions on the Residential Tenancy Act that you can only take advantage of those in a suite turnover. So it's a little bit harder to sort of project out how you might reposition a building over time. But in general, those rents are going up very, very quickly as we bring in more and more immigrants. I think we all know we're looking at 400,000 immigrants a year over the next 3 years. That's definitely gonna put a safety net under rents. The last thing I would say about that is costs are going up potentially faster than rents, particularly on the multifamily side. So, that is a headwind, but we've got some very, very strong owners in the multifamily space that can weather some pretty bad storms. So I don't see, a ton of pain really in any of those asset classes.
And to John's point there, when he talks a lot about the industrial markets and lease rates going up, I can tell you firsthand that what I see come across my desk, sort of from a bird's eye view of across the province, lease rates on retail, on office, industrial are continuing to go up regardless of it. So when you're looking at acquiring the real estate, you just want to make sure you're buying right into the right asset class. You want to make sure you're buying a good location, because regardless to what the benchmark pricing looks like when you buy and sell the real estate, the rents don't dictate what the property is worth in the short term. So if you're buying in a good asset with it and you're going to continue to get steady step ups in your rent year over year over year, you'll always do well in commercial real estate, regardless to kind of the interest rates that you're dealing with and stuff like that. So
yeah, that's so true. If you're buying a property that has been poorly managed, the cap rate, the going in cap rate almost doesn't matter if you have a clear view to significantly improving the rents over 2, 3, 4 years. Then really you want to be paying attention to what's your cap rate once the repositioning is taking place. And that's one of the reasons multifamily can be so attractive. There's a lot more to unlock versus a traditional long-term commercial lease.
Yeah, exactly. You're bang on, and that's where even in these markets right now, like I said, I think my prediction is obviously, like I agree with you that as interest rates rise, there'll probably be a softening of the massive price run up. But the one thing we're still shocked about is how little inventory exists. As long as the inventory remains low, demand is going to remain high. Prices will stabilize, maybe creep up a little bit, but these lease rates are continuing to go up and up and up, even in the vacant office market. That where you see offices that aren't being tenanted currently are getting back to being tenanted now. Sorry, but they're renewing at higher rates than where they were, mid-COVID. So, everything's pointing in the right direction from a landlord perspective, and to still get back into the market.
Well, yeah, and you look at it, one of the biggest effects inflation is going to have is on replacement costs. So, if you got into a property, at a decent value over the last few years, it's going to be more and more expensive to replace that asset in the next 5 to 10 years. So, for that's why I'm still overall quite bullish, right?
Yeah, no, I think one strategy too, and we're also looking into marketplaces for buyers right now, is looking at the replacement cost value of these assets. And if you're buying stuff close to or even below replacement cost value, as John alluded to there, the costs to produce these products are going to continue to go up. Kind of creates a little bit of a buffer, a little bit of a safety net of maybe where you might see pricing going just based on inflation.
Absolutely. Yep.
I'm just curious, John. So who's being impacted the most by this? If you think about the commercial market and people that want to get into the commercial market.
The easy answer, I guess, is always, those on the margin. So if you were thinking and it was looking a little tight a year ago, you're probably maybe not even a candidate to buy today. It's hard to say how, what percentage of the market falls into that category. I don't think it's a huge percentage, to be honest. When I get introductions to new clients and we're doing an assessment on their last 3 years of financial statements, we're seeing a lot of very strong businesses, and I see very few where I'm just thinking, these guys are going to have a really tough time. Mostly there's a lot of strength out there. There was a lot of businesses just frankly took advantage of the CEBA loans, which fair enough, they were allowed to, so why not? So we've seen just an actual strengthening of balance sheets through the pandemic, which I don't think anybody would have predicted. So yeah, who's affected? Like I said earlier, I almost think you have to look more to those that are holding higher interest short-term loans. So that might be marginal developers. It might be people who were getting into properties to reposition them, and they were taking on bridge loans at 7% that are now going to be potentially pushing up to 10% in the next year. That makes a big difference. So, it's those people that were taking bigger chances and were cutting things a bit closer when things looked really good that will be feeling the pain, but maybe that's less than 5% of property owners. Like, I don't see it hugely swaying the market overall.
So is it fair to say that the owner-occupier market there is still going to continue to drive a lot of some of these, strata pre-sales and stuff like that we've seen over the few years? You guys predict that's still going to carry forward?
Yeah, I do. And I think lease rates are a big part of that story, because if lease rates were still $12 to $14, but you saw industrial prices go from $400 to $700, which they did in the last 2.5 years on industrial, then you would be thinking, okay, this leasing looks pretty attractive. But the fact is, lease rates have almost doubled in that time. They've gone up about the same proportion from kind of $12 to $14 to now $21, $22. So that dynamic hasn't really changed. They're still looking at this comparison and thinking, I'm putting a lot of money into my landlord's pocket over the next 5 to 10 years. Why not put that equity back into my pocket?
Yeah.
So yeah, I do see that dynamic continuing. The market's gonna be interesting for sure over the next 2 years to see if we can maintain these sales prices of 700 plus per square foot, even on larger base stuff. But so far, they're still getting the buyers.
I'm going to just go a little bit off topic here for a second here, but I know every time we have you on, or we have Alan or anyone from Impact, you guys see all the deals come across your desk. I mean, there's brokers from all over the province, buyers from all over the province putting paper in front of you to try to get financing. Where are you seeing an uptick of deals from? Is it Northern BC, Vancouver Island? Is there markets there that you're starting to see increased activity in over the past year that maybe aren't on a lot of people's radar?
Yeah, and I'm glad you said the past year, because I don't really see any markets drastically heating up right now. It'll be probably more of a story of maintaining and maybe going back to more sort of balanced growth levels. But in the past kind of 12 to 18 months, we got a lot more questions about Vancouver Island and the Okanagan in particular. And those are, still pretty large population centers that appeal to a broader part of the market. When you start looking at the really small markets, like some I mentioned before, the Prince George's and the Fort St. John's, Vanderhoofs, that's generally a certain type of buyer that's comfortable with kind of a lower growth profile with much higher income though. And they're much more focused on cash flow. So we definitely saw a lot of interest. Like I said, Victoria, we were seeing deals where we were forecasting out, 65 to 70% loan to value in Victoria and Langford and Colwood, the markets that, have been talked about a lot on the show. And William Wright's had some great listings over there. It's pretty attractive when, as an investor, you're looking at only having to put 30 to 35% down versus 55% down across the water in, Burnaby or New West, right? So, and a similar dynamic in the Okanagan.
So, John, before we let you go, because we know you're very, very busy here, we have our alluded 6-pack of lighthearted questions I always ask you. We're not letting you leave without them, so we're not going to give you the option to stay. We're just going to tell you that we're going to kick this off.
Can't wait.
The 6-pack is powered by our great friends over at Red Point Law.
Oh, the guys at Red Point Law are fantastic, Cory.
For all your legal needs when it comes to commercial real estate, visit them at redpointlaw.ca. First question, John, and this may have changed. Favorite vacation spot?
Last time I said Costa Rica, I believe. So I'm going to go with somewhere I need to get to, which is Hawaii. And
that's
I
a
can't
good
believe
one.
I haven't been yet, but I need to get there next.
Yeah, I think Adam, didn't you just get back from Hawaii?
It's a good spot for
Adam just got back
young
from Hawaii.
Families, John. You're a great candidate for it.
Adam's living the high life off his equity in Kelowna.
I love how this joke's just been the new joke of the podcast is just make fun of my finances, but I love it.
I'm making fun of them because you have finances. Try not having finances.
Oh man. All right.
It's getting some good use. Yeah.
Your go-to karaoke song, John.
Oh man. The last one I remember trying was New York by Jay-Z, and my God, it's pretty hard to rap that fast. Like, I was just a disaster.
Well, there's that continuous gangster rap on the podcast.
Yeah.
Totally. Yeah.
But also that's a brave
song.
I would never take that on. But that's you must have had a few.
Maybe, and I kind of got thrown into it. I didn't have much choice, kind of like this 6-pack.
Did you have a 6-pack before you did the JC? That's what I want to know.
Yeah,
all right.
Probably.
If you're not thrown into the karaoke, but you get to pick your song, what's your favorite band?
Well, I can't really change my favorite band. I went with Led Zeppelin last time, and I played the drums since I was 11, and my brother had his Led Zeppelin CDs on, so I started picking up some John Bonham drum beats, and you can't go wrong with that. So
nice.
That's always stuck.
Very nice. Very nice.
Great.
Yeah.
What is one book you'd recommend for our listeners?
Oh, one book. You know what? I can't remember. One of your recent guests said about the Great Depression. It was called A Diary of the Great Depression, something like that. Very, very interesting. And so many similarities today, not in the way that I don't at all think we're heading into a depressionary type of environment, but just how people haven't really changed since then, and the psychology hasn't changed. The terminologies are pretty much parallel. It's a really cool read, actually.
Something you've spent for $1,500 or less recently that's changed your life in a good way.
Ninja air fryer.
No air
doubt.
fryer.
Wow.
Unbelievable.
Costco.
Yeah. Life changer.
Yeah. I will say this, surprisingly or not, steaks in the air fryer are amazing.
Wait, is that's
yes.
the thing?
Yeah. I can't remember if
everything works. Everything. It's unbelievable.
You can put everything in the air fryer and it comes out better.
Like vegetables come out actually, excited. Like I'm excited to eat vegetables.
They come out so charred like the barbecue.
Yeah,
they're just amazing. Like Cactus Club quality crispness to your broccoli from your Ninja air fryer.
You got it.
Sounds like a third sponsor for the show
This
coming up.
commercial real estate doesn't work out. You sales rep.
Yeah, if this fails, I'll be the guy at Costco on Sunday testing the air fryer at the end of aisle 7.
Yeah.
And John, what are you binge watching these days, or a movie recommendation?
Better Call Saul. I just finished the 5th season.
Oh wow!
And it's awesome. So if people don't know, it's the prequel to Breaking Bad. And it's a little slower. It's actually quite slow at times, but it's just done so well, and the acting's so good. It's awesome. All
right, John. Last question here for you. A piece of advice for our listeners who are heading into a higher interest market. What's some piece of advice on the financing side?
Don't be afraid of honestly, don't be afraid of higher interest rates. Whether that means having to resort to the alternative market to jump on a great deal. If you know you're getting a great deal, maybe you have a distressed buyer, you can get some amazing things done with bridge lending, and happy to chat with anyone about that. But also conventional rates, as long as you can look out 2 to 3 years and know you're going to be able to make your payments, that's what really matters, because like we talked about, inflation is going to drive all assets higher over time. So the important thing is just being able to hang on.
That's fantastic. Well, John, how can people find out more about what you're up to, and of course, Impact Commercial?
All of our contact information is on our website. I've got a Instagram account, Vancouver Commercial Mortgages, and we've also got our Impact Commercial Instagram. Lots of ways. We're highly accessible and happy to chat with any new faces.
Awesome. Thanks so much for taking the time today, John.
For sure, guys.
Thanks, John. Bye. Take care. And there you have it, folks. Our interview with John Switzer, partner at Impact Commercial.
I was spending the most of the interview trying to understand if John's a glass half empty or half full kind of guy. It was a real balancing act there.
Yeah, I think
at times I was scared about the market. At other points, I was like, nah, it's going to be business as usual.
Yeah, well, I think I think kind of probably the best way to describe it is John's glass had a hole in it, but he kept filling it back up. So, so it was always half full. So you got to appreciate the positivity. I think the one thing that's great about having John on is he's not gonna BS or try to sugarcoat it in any way. He obviously brought up the big pink elephant in the room, why these rates are, why they're going up so fast, what's impacting that,
right?
How does that tie into inflation? So he does that, but at the same point in time too, he always comes back around and says, hey, but don't worry, just go buy multifamily.
Yeah. Well, usually the pink elephant in the room is Matt, but he's not with us today. So I appreciate you explaining that one. Cory, what else is going on? Commercial's clearly still busy. You're busy.
Yeah, we're still really busy. Like we talked a little bit about on the episode there, just lack of inventory out there.
Right.
Interest rates obviously will have an impact, you would think, at some point, but also John alludes to how much money is on the sideline still that hasn't come into the market. And when good assets come in, we saw recently, we talked about this last show, a good asset in Nanaimo, an office building, had 11 offers on it, sold
Crazy.
Unconditional, just unheard of. So it seems like there's a lot of that money that's still around, and that will always kind of propel this market. And we've always suffered from lack of inventory. So, we're still steady, put it that way.
So if things soften, is it like institutional money or is it cash buyers? Like who's going to have the most leverage in a market like this?
Well, traditionally when you find like a lot of the institutional type buyers, they're coming in with cash and they'll refinance the asset after closing. So it gives them an advantage in that situation. If you ever find anyone with a great asset that maybe has to liquidate or they're a little tight on cash, it's a lot of those big REITs and institutional type buyers and stuff like that can come in with a cash, with a quick close, quick subject period, which that science can pick up a deal when guys need to move. So, that's typically who wins that out, unfortunately.
Right. Has your advice for buyers changed at all?
No, not at all. We've obviously been very bullish on, John talks about it as well, Vancouver Island, BC Interior. Just buying into markets where you do have still growth before. So even if you buy something today and you're paying a little bit more on the debt to get it and you pencil out 10 years on it, you're not going to go wrong on Vancouver Island. You're not going to go wrong in downtown Kelowna. You're not going to go wrong in Kamloops. You're not going to go wrong in Chilliwack. So I think it's just a matter of just making sure you're buying smart right now. Just buy smart. In case you have a little bit of a hiccup here, you just make sure you have the finances to weather the storm, and then you'll be totally fine.
So if I am a buyer or a seller, how do I get in touch with you guys?
You can reach out to us at our Vancouver office anytime at 604-428-5255. You can visit our website, williamwright.ca. And you're always welcome to email me, Cory@williamwright.ca. Always happy to talk real estate.
Excellent. Well, have a great week, guys. And we're back next week with another fantastic episode.
Thanks so much for listening, guys. Take care.
Subscribe today.